Welcome to the SNN.Network Canada virtual event. I'd like to introduce our next presenter, Chris Dobbin, President and CEO of Nova Leap Health. Sir, the floor is yours.
Great. Thanks, Matthew. Appreciate it. Thanks, everybody, for joining. I'm gonna do this probably a little bit different than what I've done in the past. For those of you who follow the story, you'll know that I've got lots of YouTube videos up there for past presentations I've done. You've heard me speak at other conferences and so on. So I'll probably do this a little bit different, but I'm starting with really three assumptions. One, you're here to listen to me speak because you've already done your work as an investor or potential investor, meaning you know our history. You looked at our filings or our press releases, but you know what we're about. Two, you all have access to the internet, and everybody can download our corporate presentation after this, and so there's no need for me to go at page by page, line by line. It's accessible on our internet, on our website, and you can download it anytime. And the third is that I'm approaching this presentation from the perspective of the audience, meaning I'm speaking to an investor audience as opposed to some of the presentations I do as part of industry panels and so on. So it's with that audience in mind, either investor or potential investor, that I'm sort of sharing my thoughts on this. So as I reflected on what I really wanted to accomplish today, I thought about approaching this slightly different than what I've done in the past, which is to kind of go through our history and talk about looking forward a little bit and where we are almost on a slide by slide basis. But it struck me that this is a conference that's put on by both Robert Kraft's company SNN and Paul Andreola, and so it got me thinking of a YouTube video interview that Robert actually done with Paul back in October 19, and the title of that was "The Art of the Roll-Up: 7 Keys to Success with Paul Andreola." So again, it's on YouTube. It's an October 19 interview. The Art of the Roll-Up: 7 Keys to Success with Paul Andreola. And this interview would come shortly after Paul's group at Discoveries there had actually put a paper on the website that I actually thought was well done. And so I'm going to speak to each of the 7 that Paul has spoken to as part of his 7 keys to success with roll-ups. And these are common denominators for success. I'll speak to all 7 of those as it relates to Nova Leap, and so I'll try to tie those together. But let me quickly go through those 7 things. One is it's a fragmented industry. 2, these are boring industries. 3, the ability to capitalize on succession challenges. 4, the operators are good at cash, equity, debt, and in a transaction in terms of how they deploy those. 5, the value is accreted from day one of the acquisition. 6, these are value-driven multiples that the acquirer is paying, and 7, the acquirer has the ability to move quickly on an acquisition. So I know I went through those quickly, but I'll summarize those as we get through. So first, fragmented industry. So let me hop to our slide that talks about industries. I think it's important. So we're focused on primarily the non-medical side of the business. So this is dementia care, which we do a lot of. Light housekeeping, meal prep, transportation errands, medication reminders, activities of daily living, to name a few. But it's really anything we can do to keep people within our home. And we're generally speaking about seniors when I refer to people, those that are 65 plus. And our market is primarily those that live with dementia. This is important from we hear, I think, everywhere these days about inflation. And so let's just talk about that a little bit. We have pricing power. And the reason that's important, and if you've gone back through our quarterly history, you'll see that our gross margins have been very, very consistent. And so this is not a Medicare, Medicaid type company. Again, as you know, we're in the private pay, or what a couple of our analysts will say is a cash pay type of business. So if we see inflationary pressures, we do have the ability to adjust our billing rates accordingly, and that's how we can maintain our margins. So again, primarily a non-medical company in the private pay space. So as Paul spoke about fragmented industry, when I started this business back in 2016, and this again was after our family's experience with home care for the first time, then acquiring a home care business, and really doing the research on what the industry looked like, it just struck me that there would be thousands of succession planning or acquisition opportunities in the years to come, primarily in Canada and the U.S. And that view that I had back in 2016 is a view I still hold. Right? I mean, we've done or announced, I think, 19 acquisitions over the course of the last 5 years, and the ability to acquire these businesses is really never ending. It's just a constant stream of opportunities. So I think Nova Leap hits Paul's first criteria of success with a fragmented industry. We're in that industry. I mean, this is very much a fragmented industry. I don't think any rational person could argue against the demographic trend. I mean, the reality is we have an aging population, and that aging population leads to opportunities, and the opportunities are created because when people attain the age of 65, there's a high probability that they have at least one chronic or long-term condition. Okay, so this is an industry that has tailwinds behind it, given the demographic trends, otherwise known as an aging population. And so that's where we fit. So I do, again, pretty comfortable we meet the criteria, the first criteria of a fragmented industry. The second criteria is a boring industry. I can tell you from a lot of the conversations that I've had with both investors and an analyst that cover us, it's exactly what they call us. I mean, they say they'll say, look, you are in a boring industry. And in Paul's interview, we talked about 3 specific industries that were successful with roll-up strategies. One was garbage, one was funeral business, and one was auto service. And so I'm making the assumption that he was talking about waste management, Park Lawn, and Boyd Auto Group as being 3 examples. Certainly in our industry, within the home healthcare sector, Medisys, LHC Group, Addis have all grown through multiple acquisitions over a period of at least a couple decades. And we've seen other Canadian companies. Constellation Software is always one that comes to mind to me. That's a serial acquirer. So those are companies that have been very successful, but we meet the definition from an industry perspective of being in a boring industry. I mean, it's very easy to understand. We're providing home care directly to seniors within their home. I mean, it's an easy to understand. It's not SaaS based. It's not blockchain when it was hot or cannabis when it was hot. I mean, it's really, really easy to understand. And so I'm pretty comfortable that we meet that second criteria of being a boring industry. So we've now covered 2 off. The third is capitalizing on succession challenges. And I'll take you quickly to our map, and this is a bit outdated. We've just closed a couple transactions, one in Oklahoma and one in South Carolina, so we've got to add a couple of spots here. But when we're talking about the acquisitions that we're making, I generally look at them from 2 perspectives. One is succession planning, and 2 is the ability to potentially partner with a younger individual, younger owner that wants to grow the business beyond his or her current footprint. All of the deals we've done so far have been succession challenges. These are owners that have built the business at generally 10 or 15 years old, and they're tired, and they're looking for an exit. And a lot of them, and I use the word tired because a lot of them say that, we're tired. It's time for us to move on, or it's time for me to move on, depending on the situation. So, 19 closed or announced transactions, and they're all succession opportunities. And so again, I go back to Paul's criteria in terms of capitalizing on succession challenges. That's what we do. That's literally what we do. And so we look at this chart, this page here. We talk about organic growth, acquisitions, and joint venture part. I mean, our growth has been led by succession opportunities by way of M&A, by way of acquisition. And as you know, we've just announced in part of our Q3 that we plan on taking a business that was just over 20 million of annualized revenue to north of 100 million over the course of the next 5 years. And that we'll do that primarily by way of acquisitions because there'll be succession planning opportunities. So again, I feel pretty comfortable that we meet the third criteria that Paul's listed out. The fourth is good at cash, equity, debt in a transaction. So really what he's talking about there is the ability to utilize different financial instruments as part of a deal. And I'll just take you through another slide in terms of what we typically look at. The one thing about our company is we're consistent. I mean, anybody can go look at our press releases and see how we've done our deals, and there's consistency throughout the last 5 years in terms of how we deploy that. So when I look at this criteria, again, good at cash, equity, and debt transactions. Specifically, one of the things he mentions is a VTB, otherwise known as a vendor takeback. Sometimes in the U.S. in particular, they'll call them promissory notes. They don't often refer to them as VTBs in the U.S. We have done a number of different things. One, we've always had cash on closing as part of all the transactions, so that's what the owner would receive. In almost all of our transactions, we've had some form of VTB or promissory notes. I can only think of 2 that we haven't, that were done. Matter of fact, I think it was our first 2 transactions. So I off the top of my head, I can't think of any other out of the 19 other closed or announced where we haven't had a promissory note or vendor take back. In a couple transactions, we've had an earnout, and which means, if certain criteria is met, typically around revenue, then, certain payments are made over a period of generally 2 to 3 years. So again, we've done that on a couple occasions. And we've had bank financing on 5 separate occasions with one of the largest banks in Canada who has supported us, certainly from a very early stage, starting back in 2017, really before we had any line of sight and profitability. We didn't have any cross-border experience at the time, and they came in really early to support us. So again, when I look at his criteria, which is his 4th criteria, good at cash, equity, debt, and a transaction, and specifically talk about VTB, and as I think about how we've always structured our deals around cash on closing, a VTB, maybe an earnout, maybe a combination of VTB and an earnout, and the ability to leverage bank financing, again, I feel pretty comfortable we meet that criteria. And so I think we've met thus far the first 4. So as I think about number 5, value accretive day 1, and number 6, which are value-driven multiples. I'll just stay on the slide for a second because I think they sort of tie hand in hand. Again, we've been pretty consistent back to the deal structure in terms of how we've actually made these acquisitions, and we've always tried to do them somewhere between 3.5 to 5 times EBITDA. It does vary depending on the location, size of business, how well it's run, the management team staying in place, and so on. So there are sort of different things that we'll look at as part of a deal, but they've been fairly consistent within that range. I think our average acquired revenue, for example, maybe this is an update of the last 2 or 3, but I think part of our most recent announcements was about 0.55 of revenue, 55% of annualized revenue. That was a bit of a benchmark in terms of where we've been. And so we haven't deviated very much from that range. There may be the odd one, but really it's been pretty consistent throughout. And so, these are accretive to us. We think we're getting good. We think that the right multiples to pay within this industry. We think those multiples are going to remain pretty consistent for years to come. We don't expect much deviation from that. Again, there may be the odd one for a particular reason, but we've been pretty consistent there. So I think about 5 and 6, value being accretive day 1, and value-driven multiples, meaning not deviating very much from what would be considered reasonable. I feel pretty comfortable that we meet that criteria, those 2 criteria as well. And then the last one is really the ability to move quickly on acquisitions. So let me just spend a minute on that. We do have that ability. Matter of fact, when we look at opportunities, whether they come through our direct outreach or whether or not they come through the broker network, we evaluate the opportunities pretty quickly, and we can get to an LOI pretty quickly. We've certainly had a number of occasions where we've got a signed LOI, and then the time to close has been a few months. That could be because of the licensing issue, or it could be simply because the seller's never been through this process before, which most of them haven't, and it's new to them, and it just takes a bit of time to get all the information we need through due diligence. But on our side, certainly on our side, we do have the ability to move quickly, and so with the same M&A team, we have the same post-acquisition integration team, same processes we use on all the deals, same technology, same due diligence, same legal team, same, right? Again, consistency is one of the things I think we're known for. And so again, I feel pretty confident that we meet that criteria. So let me summarize those 7 first, and then just touch on a couple points. So 1, fragmented industry, we meet that, we're in it. 2, a boring industry. People tell me that enough that it's been ingrained in me. I know we're in a boring industry from the perspective of investors, and that's quite honestly to your advantage. 3, capitalize on succession challenges. That's what we do. And when I say capitalize, I mean we're negotiating, I think, favorable deals for both the seller and for us. And our intent is to do that for a few years to come, and I think we will. 4, good at sort of the deal structures, cash, equity, debt, and transaction. I've spoken about that and feel we meet that. 5 and 6, value created from day one and value-driven multiples. Again, I'm pretty comfortable we do that. And 7, the ability to move quickly on the acquisition. Certainly we can do that, and have done that. I mean, I could think of the Ohio transaction we did at the tail end of 2020. I mean, we signed and closed that within roughly 30 days. So, it's evidence of our ability to move quickly when the other side has the ability to do it as well. So let's talk briefly about our financials, and then some highlights I think that are important, and then open it up for Q&A. So this is our financial profile. Those you know, I always talk about things in incremental basis. Again, we started back in 2016 with $40,000 revenue US, and we're trending upward nicely until COVID. COVID had an impact, and now we're starting to see the trend back up, obviously, driven primarily by acquisitions, back to this whole concept of succession opportunities. And so, we expect this to continue, right? I mean, we expect our growth to continue, so much so that in Q3, really for the first time, we announced, what I indicated was what I thought our path forward would be, and really put out two major metrics. One is on the revenue side, and one is on the EBITDA side. And so for our annualized revenue target, so think about this as a revenue run rate exiting 2026. We said our target is minimum $100 million, at least $100 million by the end of 2026. And so when you work that math back, I think that's a pretty reasonable target when you think about the acquisitions that we could do. Even if you think that we can acquire $15 million of revenue each of the next 5 years, we've indicated that we expect to achieve at least $30 million by the end of Q1 2022. I think that target is quite achievable. Otherwise, we wouldn't have put it out there. Second is adjusted EBITDA target, annualized adjusted EBITDA target. And so our plan would to get to a minimum of a 10% consolidated EBITDA threshold, and I believe that's also achievable as we scale and we get the operating leverage that we should. So let me just touch on a few points in terms of, again, from investors' perspective. 1, we've had 5 consecutive quarters of revenue growth. And out of those 5, we've had 3 consecutive quarters of record revenues. We have just closed 2 deals, one in September, which was the Oklahoma-based business, which I think closed on September 20th. So only had 10 days of in that quarter, obviously in Q3. And then we closed one just a couple weeks ago, or even a week ago in December, which was the South Carolina-based business. So really 2 deals that will be, I guess, fully baked in between the 2 of them in really Q1 of 2022. We're growing. We have significant growth to report in the future versus what we just reported in the last couple quarters. Again, we just closed 2 transactions. We have 2 that we've already announced, and we're attempting to close both of those announced deals by the end of this year. Whether we do or not will be subject to licensing. Both of our licensure states, we're going through the licensing process right now. I think we're moving along quite well, and we are attempting to close both of those deals by the end of this year. And so when you think about that, if that were to happen, if we were to close both those transactions by the end of the year, you really are not going to see those baked in until Q1, which of course ends in March 2022, which then get reported within the first 6 weeks of the year, which would take you into May. So I think that gives you an advantage. The fact that you're here, you know that. We've reported it. And what you end up having from a stock price perspective oftentimes is people wait for the actual results, whereas those that are at advantage have that information and can start accumulating position, which is what's happening for some folks right now. We've had a lot of insider buying going back to August. I know I personally purchased shares certainly in the mid-70s. Can't remember what they were right now. We just had one of our directors purchase another 50,000 worth of shares, and we had another director going back to August. I think he's purchased at least 150,000. We got a separate director who's purchased, I think, somewhere between 25 and 50. So there has been fairly consistent insider buying happening since August. We have a strong M&A pipeline. I get this question quite a bit, which is, what's your pipeline? And my answer is always, well, it just keeps growing. It never ends. And people want this dollar value as if there's some finite end to it. And the reality is not. I mean, we get opportunities every week. And again, I go back to this fragmented industry and the fact that there are succession plan opportunities. People are tired, and coming out of COVID, I don't know if they're more tired, but they're still tired. And so this concept of a strong M&A pipeline, this ability to continue acquiring is real. I mean, it's what we see on a regular basis, how we've grown our business, how we expect to continue to grow the business. I think, and I don't talk about our stock price right now, but I think we're at a pretty attractive spot, which is why you've seen the insiders buy. I mean, why else would insiders be buying? I mean, we think it has come off certainly from its high of 99 cents, and we're I believe demonstrating our growth. And I get when people maybe look at some of the revenue or EBITDA charts and they look back and say, well, between 2019 and 2020 it was flat on an annual basis. But if you think about where we are, I mean, we've just reported or just announced transactions that, if you sort of take Q2, Q3 versus what we've just announced, which will be baked in the end of Q1, I mean, we're talking about potential for 50% top line revenue growth. So that's significant to us. And I think we're still very much undiscovered. And again, this is the advantage that investors have when they come to these conferences and listen to the presentations and do the research, is they get information that others don't. I mean, those that dig deep into these stocks, just like Paul talks about in terms of how he started the business when they looked at all the filings through SEDAR. I mean, when you put in the research and you do the work, you find things that others don't. I can't tell you how many times I get a question once we put a press release out. People ask me a question, and they could have read the press release, and they don't. I mean, people just don't take the time these days to put in the work. And whether that's a function of having everything at our tips through social media or a smartphone or whatever, the days of actually spending time, I personally find people just don't do it as much as they used to. And again, that creates an advantage for those that do. I mean, people that put in the work see the results. And I think that's what we're starting to see as a company. And I think that's the advantage that folks have on this call. So I think I'll end there and just take any questions that are popped up. So again, I appreciate your time. I wanted to sort of tie this back into just give a little bit of appreciation for SNN and Paul's group putting on this allowing for me to do the presentation here as part of their overall conference. And so I thought it'd be a good idea to tie back to, one of the YouTube videos they've actually done as really part of a concept that applies directly to us. So Q&A, let me go to the questions here. So you have strengthened your team in an impressive way over the years, but are there no plans to bring in industry knowledge from someone who operates and knows the home care industry from the United States? That's an interesting question, but the way it's written seems misleading. That's actually all we do, meaning that we only bring in people with industry knowledge in the U.S. So our vice president of operations has significant industry knowledge, operated home care for years in the U.S. Every single one of our operators or regional directors has direct home care or healthcare experience, every single one. At the corporate level, we just added 2 new directors, one who has direct industry experience both in Canada and in the U.S. So if there's an assumption as part of that question that we don't have industry knowledge from people that operate, then that's a false assumption. I can tell you that right now. We only have people with industry knowledge that are operating our businesses in the U.S. Second question, how affected your business today by COVID compared to a year ago? again, I think you just look at the results and you'll see that. We report on that in our MD&A and our financials every quarter. So I think we do a fairly good job of that. 3, do you notice any increased interest from institutions or funds? We do have some MicroCap funds that have been investors, have been great supporters of ours actually for the last, probably going back to 2018, I would say. And so we've got 3 that I can think off the top of my head that have been very, very good supporters of ours. I wouldn't say we have institutional ownership in our company right now. And again, I'll take it back to Paul's comments, as he typically does. I mean, when you find undiscovered companies prior to large institutional ownership, that's your advantage, right? As investors, right? Because when the institutions come in, then typically provided execution is done properly, then typically the stock price moves. So, no, we're definitely not, institution, don't have a lot of institutional ownership. How do you feel about the increased insider ownership lately? Great. I mean, anytime I buy in the open market, or one of my fellow directors or CFO buys in the open market, I think that's another positive sign for the market. I mean, I'm not sure how you can think about it any differently. We're almost, I think, 37% insider ownership. I think I'd have to see the 35.7, 36.7. It's one of those two. So 36, 37%. So I feel really comfortable with that. What's your vision for the company for the next 12 months? Where would you like to be? Look, I'll refer you to Q3 press release. I mean, I put it out there, right? I mean, I talk about 5 years, not 12 months, but that should give you a flavor of what we're trying to do. And so if you want to sort of take that math back over a 5-year period, I think you can do that. But again, we haven't put out any guidance or any targets for 12 months. We've done it for Q1 of 2022, which is to be north of 30 million. And we've said what our exiting 2026 would be, but we have not provided guidance or targets for the next 12 months. So I can just refer you back to Q3. You have recently made a couple of acquisitions. Yes. Assuming that these are all closed, what's the annual run rate of revenues, assuming full year contributions from all acquisitions? Again, I can just refer you back to press releases. You'll have to do the math. We've just announced what we've indicated for the end of Q1 2022 and 2026, as I've alluded to. And so I think those are just mathematical calculations that you have to run. Can you talk about free cash flow going forward and your ability to self-finance additional acquisitions? Again, we haven't put any guidance out there, but let me just talk about self-financing. So let's talk about the way this model works, particularly under a compounding model. When we're generating significant free cash flow, then we have the ability to deploy that in a couple different ways. One is, we can pay down debt. As you think about allocation of capital here, let's just talk about that for a second. We can pay down debt, but we do that, just on a monthly basis anyway. So we don't currently have any plans to sort of bulk prepay. We could buy back shares, which we don't have any intention of doing right now. We can pay dividends, which we don't have any intention of doing. So it's really two other choices. One is organically, meaning putting money back into an existing operation. We would do that if we thought that agency had the ability to expand. Or the last alternative, of course, is M&A, and that's generally where we put the money. But as these companies are generating cash flow, and we put these back in M&A, and we generate an increased amount of EBITDA, then as that EBITDA number increases, then our ability to leverage deals increases, meaning we have the ability to get more debt financing, right? So you put together a meaningful amount of EBITDA on a go-forward basis as a result of acquisitions, and you think about, and I generally think about 3 times EBITDA as being a reasonable amount of EBITDA, debt for these types of businesses. So just sort of bear that in mind. That's the way I think about it, as being a reasonable amount. So that should give you some sense of what we think the debt opportunity is. Okay, last question: How do potential sellers learn about you? Two ways. One is we reach out, so we have a direct outreach program, and 2 brokers know who we are, and so they send us opportunities. quickly because I'm running out of time here. Do you have to go through licensing in each individual state by operation, or is it a corporate entity? It's by the we set up separate entities for acquisitions. So we go for that entity by state, but it's not every state. I think out of the 50 states, there may be 32 of them that are licensure states. How do you implement the similar winning culture? I'm not sure exactly what that means, other than the fact that we've got great people, and we're only successful because of our people. And I can tell you, having gone through COVID and how stressful that was in the early days, and our people were working through the hours they were working to make sure that both our clients and our staff were safe, that, that's the culture I want. We have people that I would work with anytime because I trust them. And when you have people that you trust to make the right decisions for your business, you can't ask for anything more than that. So with that, I have probably exceeded my time by a minute. I just wanted to thank everybody for coming out to the presentation. I enjoyed the questions. My favorite part of the presentation. If you ever have any questions, just reach out to me directly by email. It's probably the easiest. I'll get back to you as soon as I can. But thanks very much for following along, and enjoy the rest of the conference. Take care.